Good evening, traders. It is Wednesday evening, May 6th, and it is time for our weekly swing trading video. We've had kind of a dull week to the market right now, and I feel that we're getting into a tight trading range here, and the market is getting ready to transition. We're seeing two-sided price action. I feel that with every passing week, the likelihood of a market decline increases, and I'll tell you why in just a few seconds. So let's take a look at where the major moving averages come into play. We're going to overlay the 200-day moving average, the 100-day moving average. You can see how they're both converging right at that $300 price level. And I'm going to go into the weekly chart very quickly. You can see that 288 level on the SPY, which has been critical. That was our first target. We reached that target. You can see a couple of long tails above body here, not able to get through that major resistance level right now. So I feel that from a trading standpoint, as far as the range that we saw from the highs in February to the lows in March, we are right at that midpoint. And I feel that asset managers are sitting back waiting for some clarity. They're not getting it from earnings season because corporations are pulling guidance. So they're not getting it from that. They don't know how quickly states are going to reopen their economies. States seem to be dragging things out. I just read today that New Jersey is extending their shutdown. So consumers also seem to be very, very concerned. When I go to the store now, I see everybody with their masks on. You can just tell by the look and the feel that everybody's very concerned about the current conditions, and they're worried that this virus might pop up again in the future. As far as reopening, we've got states starting to reopen right now, but that's been a very gradual process. Now, we've got China, who actually has gone through this whole procedure. They are the litmus test. They are the first ones to try and reopen their economy. And the news that I'm seeing from China is that consumers are very, very cautious. They're really waiting to see how quickly the economy can recover before they open their wallets, before they go back to their previous lifestyles. So that same type of behavior is what we're likely to see here in the US. So let's take a look at what we have technically on the charts. And you can see how we came up and we tried to poke through that 288 level, and then we sold off below it. We had a couple of instances this week where we tried to rally back above that 288 level. Not able to. Market sold off hard. Let's take a look at the price action that we had yesterday, and everything seemed to be really in place for a nice rally. Let's go back a little bit further. The day-to-day price action is very, very telling. So you can see here that we're up above that 288 level. We have a big gap down. Market sells off the entire day, and it stays down on its low, closes on its low. Then we have follow through selling the next day. This was Monday, and a nice little rally up towards the close Monday. Now, Tuesday, we gap higher. Yesterday was the day where it looked like, hey, we're back off to the races. Look at this. This is going to be fantastic. We have this gap higher. Market rallies a little bit, compresses, and then we get this really nice, steady push higher. Little bit of a dip there. And as we came back up to challenge that high yesterday, it looked like we might poke through and maybe we are going to rally right back up. Uh-oh, look at that. Late day selling. That's always a warning sign. Today, no problem. Little overextended on the sell-off there. Market gaps up. Okay, here we go. No, not so fast. In fact, on this dip right here, we took out the prior day low and tried to fill some of the gap. Continue. Late day selling for a second day in a row. Go back to that daily chart. So the warning signs are there, and you could see a tiny little head and shoulders formation maybe starting to form. Shoulder, head, second shoulder. We need a drop and a breakdown below that 277.50 level to confirm a head and shoulders formation. Right now, we've got a lot of uncertainty in the marketplace. A lot of countries are trying to reopen their economies, and this is going to take a lot longer than anyone expected. We've got the PPP stimulus. Businesses are going to try and rehire workers, but the workers who go back, are going to be looking over their shoulder. They're going to be wondering if the orders are there, if the foot traffic is there. They are not going to go back to their previous consumption patterns until they know that their job is secure, especially after coming through something like this, where half of the people polled recently said that they cannot pay May's rent. That gives you an idea of the credit situation on a consumer basis. Way, way, way overextended. Municipalities, way overextended. You've got people needing to pay their property taxes in the next few weeks, and I doubt that many of them are going to make those payments. The government has postponed paying your federal taxes until July, so that's out there looming as well. And this PPP stimulus check that employers have will run probably about 2, 3, maybe 4 weeks is all that it will last. If the orders don't resume, we're going to start seeing some selling pressure. So for right now, we had really good earnings from the major mega cap tech stocks: Apple, Facebook, Microsoft, Amazon, Google. They were all excellent, but those companies benefited from the coronavirus in many cases, and they're not representative of what's going on in the other 90% of the S&P 500. The other thing that we have to bear in mind is that the companies that announced early in the earnings cycle, they tend to be the strongest companies, but they also had the least amount of data available in terms of how coronavirus impacted them, because the shutdown was just beginning in the last few weeks of their quarter that they reported. But now, with every earnings report that comes out from this point on, more and more weeks of the shutdown will be included in those numbers. And I'm hearing time after time after time when I read these reports, Q2 is going to be much worse than Q1, because that's when we're really going to see the results. We've had horrendous economic numbers coming in, and I think they're grossly understated. When they take these surveys or when they try and collect the data, there's nobody there to get the data from. And I don't know who's collecting the data either, but when I saw ISM manufacturing and ISM services, I thought those numbers have to be a lot worse than what is being reported. Now, the one number that I was really looking forward to this week, because it would give me some clarity, is ADP. ADP reported that 20.2 million people lost their jobs in the month of April. They process payrolls for small and medium-sized businesses. They know how many direct deposits they made into the account. That's why I was so interested in that number. And a lot of people were shocked. Oh my gosh, this is much worse than I thought. I think 40 to 50 million people were unemployed during the shutdown. You're not seeing anything remotely close to that. Friday's jobs number, I don't know how accurate it's going to be. I never put a lot of weight into the government's number. They're always filled with adjustments and previous adjustments, seasonal adjustments. You've got the unemployment office is so inundated, they can't even process unemployment claims. They are so backlogged. So the number probably will come out better than feared, just because they can't keep up with it and they can't process all of the unemployment claims. But the ADP number, oh yeah, I think that's representative of what's really going on. So the market, you can see, is compressing in this tight range right here. I suspect that we're about 2 or 3 weeks away from getting a decent little market sell-off. Well, why not right away, Pete? What's holding us up? I mean, we should be selling off right away if the economy is going to be slow to recover. No, it's going to take time for that to play out. And right now, the focus really has been on states reopening their economies, people trying to get back into a normal lifestyle. And so there's a bit of optimism still in the marketplace. I think that with every passing week and with more and more information coming out about how the states are going to phase their reopening, then I think that there's some clarity and we start to see what the consumption patterns are when people are able to go to the restaurants. Are they going to the restaurants? When the shops are open, are they going to the shops? Are they spending money? This will be the critical data that I think turns the tide. With a major sell off like this and a nice rebound like this, you're going to have aftershocks, and I think we're due for one. So, market first, market first, market first. We have to get our market bearings before we can even contemplate a trade. So, as I see it right now, this market decline, this next leg lower, is probably going to take 2 or 3 weeks to unfold, but I do believe that it's going to start unfolding. And we're already starting to see some warning signs. The other thing that I watch for is I always try and trade both sides of the market when I day trade. I take longs and I take shorts. Now, obviously, on this rally here, I've been trading 90% from the long side and only 10% from the short side. But the price action on the shorts has been horrible. They've been small losers all the way along the last 2 or 3 weeks. And now I'm starting to see some decent opportunities on the short side. The long side still presents better opportunities to me, but at least I'm starting to see some shorts that I can make money on. And they're not all losing trades anymore. My shorts have actually been making money. Well, what's the difference? What explains the difference? It has to do with price action and momentum during the day. And now that stocks have bounced off of this low, they've gotten high enough to where there's some froth in it again. And when the selling starts, you can see a sustained movement through the course of the day. And those are little clues that I pick up on when I'm trading that tell me that the market is getting a little bit toppy and that it's ready to start rolling over. So we're still in this sideways compression. We still have some decent breakdowns uh, through technical support here at SPY 276 before we can start really getting bearish. Until then, we have to assume that we're going to continue to stay in this trading range and that eventually when we do crack, it'll happen pretty quickly and we better have some trades on so that we can start making some money when we do see that first market decline. So I always like to be very short term in nature when I'm selling premium, and I like to be longer term in nature when I'm buying premium. I don't want to have time decay constantly working against me when I buy premium. But when I'm selling premium, I definitely want to have that working in my favor. So my approach to the market right now, given my bias, is that I want to sell some out of the money bullish put spreads on very, very strong stocks. And I want to keep those as close to expiration as I possibly can. And I don't want to go out more than a couple of weeks because I'm fearful that in a couple of weeks we'll have that data and the market will start cracking down. So those are bullish positions. On the other side of the coin, I'm also going to be taking a couple of bearish positions. I want to give myself at least a month until expiration, and I want to give those stocks a chance to decline, and I want to have the market decline in that timeline also. And so I've got some bearish put spreads that we're also going to be doing. So we're going to be buying put spreads. The good news is that option implied volatilities are starting to come in. They're starting to decline. And that's good from an option buying perspective, but they're still too inflated to just outright buy puts or calls. That time might not come until September. It really depends on what the market does between now and then. So in every instance, we need to either be buying debit spreads or selling credit spreads. So let's take a look at what we did last week, and we'll take a look at some of our positions. We got into a Facebook trade last week, and that's in fantastic shape. We'll take a look at that in the staged orders, but we sold a put spread below this 100-day moving average. It expires tomorrow, and we sold it for a 35-cent credit, and that was a 2.5 point spread, 2.5 points between the strike prices. So really nice, very short-term trade. We're taking advantage of Facebook's big gap higher last week, and you can see not only did it hold the gap, but the stock has been able to continue to move higher when the market has been soft to slightly lower. So really nice trade for us. So that was one of the trades we were able to get off. Google, we were not able to execute. So that came off the list. Netflix, we were not able to execute. Starbucks we were not able to execute. VLO was the other one that we were able to get filled on. We saw this nice gap up, and that's when the video came out. We wanted to sell the uh, $60 put right here in the gap, and you can see the stock is at $60.92. We are holding without a stop. I hope we get assigned on the stock, because then we're going to turn around and we're going to sell calls against our shares. And that'll be the next part of the trade. I'm expecting refiners to continue to go higher as the economy starts to open up. They're also benefiting from very, very low input costs, which is the price of oil. So their profit margins should be healthy. So that's a position where we're just going to keep Valero on, and we're going to wait for assignment. If it happens, it's also very possible that the stock stays above $60 in the next week. If it does, we're golden. We'll keep the credit that we sold the puts for, and we'll move on. Maybe we'll even resell them. We'll see next week. So for right now, know that there's no action required, and Facebook is going to expire in all likelihood this Friday in 2 days. No issues there. We're not even close to the money. I think we're about 12 points out of the money, so no worries there. Now, I was considering doing another bullish put spread on Facebook, but the stock is too far away from technical support, so it just didn't give us an opportunity to do that. You can see right here that we would have to go all the way down to the 195 strike, and that's about $13 out of the money, so it's too far away. We're going to click on the trade button, and I'm going to go into the staged orders, and we'll take a look at what we've got there. And there you can see at the very top, these are the 4 trades that I'm going to be highlighting this week. We're going to be buying a McDonald's put debit spread. We're going to be buying a Hasbro put debit spread. We're going to be selling Clorox bullish put spread, and we're going to be selling a Google bullish put spread. So before I get into those, I'd like to go down and take a quick review of our positions. There's the Facebook position. We sold the 195 put. We bought the 192.50 put. We did that for a 35-cent credit. That's going to yield us about a 18% return or so in the course of a week and a half. Really, really nice trade. That was a post earnings trade. VLO, we still have to wait and see what happens there. There you see the orders sell the May 15 put, the $60 put naked for $1.20. I think everyone was getting in for about $1.35 because Valero pulled back instantly the next morning. And then you can also see here that we've got some positions that are going to be expiring soon. We sold an AMAT bullish put spread that expires on the 15th. FLS naked put, MU. So we've got a few things that are going to be coming off. This GILD put that we sold for $1.30 will be coming off. Actually, that already expired. So let me remove that. Get that off the screen. And then we've got a Walmart put that we sold at the $100 strike for $2.20. That thing has been milked dry. There's probably nothing left to that. You should already be buying that back in. In fact, let's take a quick look at Walmart, and we'll see where those options are. And you can see the stock is at $123. Those puts are going to be offered at a penny probably. So those are the May 15s and the 100 strike. They're offered at 11 cents. We sold them for $2.20. You should think about reeling those back in and releasing that margin. There's no reason to keep that trade on. Let's go into the staged orders. Let's cancel that. So we don't really have that many open positions right now, but we're going to be trying to add some today. So let's take a quick review of these trades right here, and let's start with the bearish trades. Once I go through the trades, I'm going to show you how I found them. And so here we've got McDonald's. You can see how the stock rallied up, and it found resistance before it even got to the 100-day moving average. Here's the earnings. You can see that the earnings came out before the open, and the initial reaction was, okay, the stock pretty much opened flat where it was the day before. Excuse me, no, it pulled back a little bit and then it rallied through the course of the day, but it gave those gains back instantly the next day. And then you can see here in the last 2 days when the market's been a little soft, how the stock has pulled back very, very easily. Now, McDonald's is another company that has exposure in China, and they came out and said that they're seeing a very sluggish recovery, that consumers are not going back in to their restaurants right away. So as you read a lot of earnings reports, you start picking up on these little clues and details that might give us a hint of how things play out here. So I feel that McDonald's has a good chance to pull back with the overall market, and their same store sales were way, way down, and not a good scenario. If they start opening the seating inside of restaurants, it's going to have to include social distancing, only, 30% capacity. I think McDonald's is going to continue to struggle, and I think that people are not going to be too anxious to go into a restaurant to eat with the coronavirus. I think they're still going to stay home and wait this out and see how things play out. So you can see that resistance there. You can see the upward sloping trend line here that's also been breached. So I like this. I like this trade, and we're going to go in and we're going to buy a put debit spread. So I'm going to bring up the option chain. We're going to go out to the normal expiration of June 19th. And there we're going to scroll down. We're going to try and go just out of the money on this put debit spread. And we're going to hope that the market comes in and that the stock follows suit. So we're going to be buying the McDonald's June 19, 165 put. We're going to be selling the 160 put. So June 19, buying the 165 put, and we're going to be selling the 160 put. And I just reversed that, so we're going to get this correct. We're buying the 165 put, we're selling the 160 put. And we're going to be trying to do this. You can see that the spread is 90 cents bid, offered at $1.20. And it's a debit. So we're going to be trying to buy this for a net debit of $1.10. We're going to hang on to that spread without a stop right now. In a week, we'll revisit the spread. I'll give you renewed instructions. We don't have a lot of risk exposure on this. Now, if you're using a constant dollar allocation per trade, this is very, very, very important. So please pay attention. We want to do half of the size, half of the dollar allocation for this trade as opposed to our credit spreads. And the reason for that is that time decay is going to be impacting us on this trade. And because we only have to put $1.10 out for this trade, we've actually can allocate a lot more contracts to it, but we don't want to do that. We don't want to have a lot more risk exposure when we're buying premium. So please only use half of your size for this trade. Now, what we're going to do is we're going to put a target for this position at 50%. So if we buy it for $1.10, we want to make a 55-cent profit on it. So your target for this spread is $1.65. And if we're successful, we're going to make 50% on this versus the 25% that we might make on our credit spreads that we execute. So risk and reward go hand in hand. The probability when you're buying premium is much smaller than it is when you're selling out of the money premium. So please keep that in mind. We're doing half the size whenever we buy debit spreads, or if we just outright are buying puts naked, we're going to do much smaller size. We've got much greater upside to it, and that's fantastic. So that's the first trade. I want to also take a look at the next trade, and we'll go into the staged orders, and we'll take a look at Hasbro. There we're buying the June 19 $60 put. And we're going to be selling the June 19 $55 put. And we're going to be doing that for a $1 debit. So let's go in, we'll take a look at the option chain, put in symbol HAS, and we're going to go down to the June 19 expiration date. And here you can see we're buying the $60 put. And we're going to be selling the $55 put. And you can see that that spread is 70 cents bid, offered at $1.15. And so we're going to be trying to buy this for $1. And there's a pretty good likelihood, because we're close to the ask, that we'll be able to get that spread done. And I've just reversed this, so let me correct that. I'm so used to selling bullish put spreads that I'm marking the wrong boxes. So we're buying the $60 put and we're selling the $55 put. And we're doing that for a $1 debit. So again, very close to the asking price for this. And let's take a look at the chart for Hasbro and see why I like that short. There's the earnings report. You can see how the stock was compressing right in here. It's now broken through the lower end of that compression, and you can see the follow through that we've had as the market's been coming in. Now the stock is at $65. We're expecting the stock to get down to the $60 and $55 level. Now for this spread to pick up steam, it's not going to have to make that big of a move. If this stock gets down to, say, $63 or so, we will start to see that spread increase in value. And maybe at the $62 value, we probably getting pretty close to being able to sell that, depending on how long it takes to get there. We'll be able to sell that and realize our target. And again, in this case, we're looking for a 50% profit on it. So if we paid $1 for the debit spread, we're looking to sell it for $1.50. So we don't have to have it go in the money. We just need it to come down closer to that $60 price level, maybe even $61, and we should hit our target profit on it. So we're just looking to take advantage of some momentum. A little bit of market weakness will get us what we want. So just a very quick recap on that one. We are going to be buying the $60 put, selling the $55 put. And we've got, in both cases, we've got about 5 or 6 weeks, which happens to coincide with my market forecast. I'm looking that with every subsequent week that the market is going to start to soften and that people are going to see that this economic recovery is going to take longer than expected. So let's take a look at the next one. I want to balance this with some bullish trades because I want to take advantage of some stocks that really, really look strong right now after earnings. And I also want to take advantage of very short-term trades while the market is figuring out what it wants to do. I think we can still make some money on the bullish side. And this is a hedged type of approach for us as well. So I'm going to go into the stage screen, and there we're going to take a look at Clorox. We're going to sell the May 15 187.50 put, and we're going to buy the 185 put, and we're going to be doing this for a credit of 40 cents. It's a little bit less than I would normally like to take, but I think that this stock doesn't move around that much. I really like it. And let's take a look at those premiums, and then we'll take a look at the chart. And so again, we're going out to the May 15 strike price. I just want to confirm that. And we're selling the 187.50 put. And we're buying a 185 put. And we're going to be looking to do this for a credit of 35 cents. And this is a credit. So you can see that it's offered currently at 40 cents. We don't have a chance of really getting that spread done right here, right now. But I feel that if the market starts to soften up the rest of the week, and we've got a big jobs report coming up on Friday, if we have a horrendous number there, given the selling that we've seen through the course of the last couple of days, we could see more weakness. And there's one other thing that I'll show you on CLX. Let's take a look at the chart right now. You can see how it got through this horizontal resistance right here. And I like that. And you can see that that horizontal resistance comes into play somewhere around the $200 199 price level. So we've got some protection there. And you can also see how the stock gapped up after earnings. So we've got lots of room for the stock to move around. But here you can see that it started to give back some of those gains today, and it was fairly weak. And I'm thinking that tomorrow we may have some follow through selling that gets it down to the 196 level. If we get a little bit of help from the market, the stock may be able to pull back down below this horizontal breakout. And you can see also that the stock tends to move around. Okay, even with coronavirus and the news being good, it has not been straight up. One thing I do like is Clorox said that they're going to be pulling a lot of their advertising because they've got so much business right now that they can't even keep up with production. So why advertise? I thought that was a pretty cool side note. So again, we had some weakness today, and there's the stock's price action today. You can see very, very weak. Well, let's hope that we get a little bit of follow through tomorrow. We're going to need it to be able to get the credit that we want. So if the market gives us a little bit of weakness tomorrow, and we had some weakness in the stock today, I think we could see it pull back far enough for us to get that credit spread done. But with a May 15 expiration, if we're not filled on this trade by Friday's close, cancel the order. We're not going to do the trade. Otherwise, we run the risk of having the stock pull back very quickly. We get filled on it, and now there's a lot of downward momentum, and we're too close to the money. That's how you get into trouble if you're trading these very, very short-term credit spreads. So we'll go back to the trade screen and we'll recap that trade one more time. We're going to be selling the 187.50 put. We're going to be buying the 185 put. We're going to be doing this for a 40-cent credit. Now, mind you that the stock is at 199.73 is where it closed today, and this spread is about 10 points out of the money. Let's call it 12 points out of the money. It's not going to take much for this stock to pull back. If we get another $2 or $3 pullback, these option premiums are going to start to pop, especially if that's accompanied by a market pullback. If we don't get filled, it's okay. Right now with the market in this juncture right here, it's directionless. We need to be careful. It could break either way. Now, I suspect that it's going to break on the downside, but we don't trade suspicions here. We need pure technical breaches before we can get short aggressively, and we don't have that right now. The market's just kind of chopping around. So we're preparing ourselves in the event that we do get a nice breakdown. We've got a couple of put debit spreads that we bought. Fantastic. On the bullish put spread side of it, though, we got to keep it very short term, and we don't want to be too far out in time. So the next and final trade this week is going to be Google, and let's take a look at that trade. So we're going to be selling the Google May 15 1280 put, and we're going to be buying the 1275 put, and we're going to be doing that for a $1 credit. So let's take a look at Google. Bring up those options. And we'll go down to the 1280 strike right here. And we're going to sell these. We're going to buy these. And you can see that the spread is offered at $2. We're going to be trying to do it for a $1 credit. And that gives us a really nice return of 25% if we get filled on this. And we're going to take a look at where the stock is trading and why that seems to be a good level for us to try and sell below. Well, one clue is off of the option table. You can see that it's below the 200-day moving average. That's the pink line, and the pink line corresponds with the 200-day moving average on the chart. There's your 200-day moving average. There's your 200-day moving average. We're also one standard deviation out of the market, out of the money, and that's the red dotted line right there. So these are really nice features that I've added to the option chain within Option Stalker. You can see how the stock had earnings here after the close. That was the first opportunity for the stock to trade. It was able to maintain that 100-day moving average, and in the last 2 days, it's actually been able to move above the 100-day moving average when the market has been weak. So we want to try and key off this 200-day moving average on the notion that it is going to preserve that breakout. Even if the market pulls back on us this week, horrible unemployment number Friday. Let's say the market really sells off hard. Everybody's nervous going into the weekend. Nobody wants to be long. That's what I'm hoping for. That's how we get filled on this trade. So don't think that Thursday, oh my gosh, the market's down. Friday, the market's down again on that unemployment number. Why are we selling bullish put spreads? We're expecting that. We want that. That's the only way we get filled on this trade. And once we get through the weekend, I think we're going to be in fine shape on these. Even if we get a big market decline, I think Google is going to hold that 100-day moving average for sure. It's going to hold this gap. And that's all we needed to do because we're still below the 200-day moving average. I don't see things falling apart so quickly that we fall below that 200-day moving average a week from Friday. I think the market's going to be pretty resilient early on for the next few weeks. So that still gives us some time to take advantage of some bullish put spreads. But Google posted a great number. Been a ton of people surfing the internet. Revenues were up 13% during the pandemic. So Google's a really strong stock. I like it. So let's take a look at how I found these stocks. And I should also mention that if there's a need for me to update any of the positions, you can expect me to do so by email. I'll send out an email alert. Google and Clorox, if we don't get filled by the close Friday on these trades, we're going to cancel the trade, but we're going to leave the other two debit spreads open for a possible fill until the uh, video next Wednesday, and then I'll give you follow-up instructions on those. So the debit spreads, keep trying to work them for the rest of the until next Wednesday, but on the two bullish put spreads, the credit spreads, they are going to expire Friday after the close if we're not filled on them. So we'll go into custom search. And I've been mentioning the earnings searches that you can use. We're going to go earnings date previous. And we're going to click on that. We're going to go to the 27th. And earnings today, that would be fine if we included today's date. So we're going to go into the option liquidity, and we're going to bring this up to at least 0. Want to make sure it's at least at 0. So if I'm looking for bullish stocks, these companies have posted results, which is good. We don't have to worry about that. And then we're going to go in, and on the bullish side, we'll mark trade signal bullish and strength versus SPY, also bullish. And there we're going to get a nice list of stocks. And there were some really good ones in here as well. Let me click on a couple. Apple looked really good. I liked it above that 100-day moving average right in there. And I was considering doing a bullish put spread on this below the 288 level, but I felt that Apple could actually pull back fairly hard. I do think they're going to have some issues with iPhone sales, but right now the market likes the number. The market's bullish on Apple, so it had the momentum and everything. I didn't want to load up too much though on the bullish put spreads. So that looked good. ATVI, really nice big breakout here, but it's so far out of the money that for us to sell below support, we would have maybe had to go up to the $70 level on the notion that it would hold that tail. Nah, not good. eBay also breaking out. Now this has not typically been a big moving stock, but I do like the fact that it was able to get through the high, and these consecutive long green bars tell me that the stock wants to move higher. You'll also see some other favorites. Facebook, I told you why we didn't do that one. Google was on there. Microsoft, really nice. Uh, So there were some excellent candidates in this list to pick from. It was that easy. Good option liquidity, recently announced earnings, buy signal, relative strength. So let's just mark bearish trade signal, relative weakness. Let's see what we get. Get a lot more candidates here. And you can see if you glance down this list, BA was another possible short, and it's been just drifting lower. You can see this downward sloping trend line. That's a good swing short. You use that trend line as your stop. Connect that. There's your downward sloping trend line. Do it on a GTC basis. Really nice. Caterpillar I had considered. You can see how the stock is starting to break down through horizontal support, lower high. So that was nice. CMCSA, Comcast, nice. So this is the list. That's how easy it was to find these bearish trades or bullish trades, and it's post earnings. So they've had an earnings reaction that we can lean on. And there you'll see down here, McDonald's. We've got one other way that we can find these. We go into scanner, and I'm going to click on bullish first, and you can see strong after earnings right here. That's another way that you can go through and click through all of those searches. And I'm sorry, but I think everything is updating right now, so I'm not getting the results in here. Unfortunately, these searches are updating as I record this, but those are also two ways that you can get to the same information. Show me stocks that have been weak after they've reported earnings. In this list, they've all reported in the last 2 weeks, and in the strong after earnings, they've all reported in the last 2 weeks as well. So then one final thing when you're looking for bullish trades, Pop Bull is phenomenal. I love these this is my favorite search for swing trades. You'll see me use it a lot after earnings season. And all I would have to do is to click through some of these results, and you see these just gorgeous breakouts on these stocks. MTCH was a really nice one in here. LVGO. Actually, they announced after the close today. Peloton announced Peloton after the close today. That stock's looking good for tomorrow. This is a great source of stocks that you can do bullish put spreads on. And same thing on the bearish side. Click Pop Bear. These will be some of your best shorts. GD's actually been a nice looking short. I've mentioned that. You can see the downward momentum there. So make sure to use these searches. You've got everything available to you on a longer term basis in the custom search engine. Now, in Option Stalker, you don't have these searches, but those are primarily for day trades, but you've got everything else. And you do have all the fields here in Option Stalker Pro. That's it for tonight's presentation. I think that the market's got maybe a week or two of some weakness, and then a little bit of bounce, and then more weakness, gradual deterioration until finally everything starts to culminate and we start to see that the economic recovery is going to take much longer than we had hoped. And I think that the market's going to soften. I think that you're going to see a lot more selling pressure coming into play. So by that time, our bullish put spreads, if we're filled on them, should expire. We do need a little bit of a market pullback tomorrow and Friday to get filled on those bullish put spreads. We need that weak unemployment number to try and get filled on the bullish put spreads. Then I think we're okay until next week. They'll expire. And we'll also have a little bit of a hedge on because we're going to have our bearish put spreads, our put debit spreads in play, and those are going to have about 5 weeks of life. So that's overall how I'm structuring our portfolio right now, and we've got a lot of way out of the money premium that we've sold that should be in good shape. So that's it. If you like the content, you're watching this video on YouTube. I post it on Saturdays. Members have had a chance to get into these trades Thursday morning. Go back and take a look and see how these picks have all performed. Please subscribe to the YouTube channel. Make sure you turn on your notifications, and then you'll never miss another one of these videos. That's it for tonight, folks. We'll see you tomorrow. Thank you. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.